South African Reserve Bank's Monetary Policy Committee has raised the repo rate by 25 basis points to 3.75%. It follows almost a year and a half of historically low interest rates on the back of the COVID-19 pandemic. The move comes as the country faces inflationary pressure, particularly due to rising food and petrol prices.
While the committee expects inflation to stay close to the midpoint over the forecast period, inflation risks have increased and the level of policy accommodation remains high. Against this backdrop, the MPC decided to increase the repurchase rate by 25 basis points to 3.75% per year with effect from the 19th of November 2021. 3 members of the committee preferred an increase and 2 members preferred an unchanged stance. The implied policy rate path of the quarterly projection model indicates an increase of 25 basis points in the fourth quarter of 2021 and further increases in each quarter of 2022, 2023 and 2024.
Kganyago said that the Monetary Policy Committee believes a gradual rise in interest rates will be enough to keep a lid on inflation going forward.
As usual, the repo rate projection for the quarterly projection model remains a broad policy guide, changing from meeting to meeting in response to new data and risks. Given the expected trajectory for headline inflation and upside risks, the committee believes a gradual rise in the repo rate will be sufficient to keep inflation expectations well anchored and moderate the future path of interest rates. Economic and financial conditions are expected to remain more volatile for the foreseeable future. In this uncertain environment, policy decisions will continue to be data dependent and sensitive to the balance of risks to the outlook. The MPC will seek to look through temporary price shocks and focus on second-round effects. Current repurchase rate levels reflect an accommodative policy stance through the forecast period, keeping financial conditions supportive of credit demand as the economy continues to recover. The bank has ensured adequate liquidity in domestic markets and will continue to closely monitor funding markets for stress. In addition, regulatory relief provided to banks continues to support lending to households and firms.
Well then, how will this rise in the interest rate affect consumers and our debt? We're joined tonight by Transunion CEO Lee Naik, who's joining us to talk more about this. Lee, good to see you. Welcome to the program. Let's begin then with that very basic question of what this means for indebted South Africans.
Well, it's important to note that, as the governor mentioned, we do have quite an indebted society right now. I was having a look at some of the data just before our conversation, and what's important to note is we look at the level of indebtedness of the current consumers. In fact, we right now measure that the level of indebtedness, which is the debt we service relative to our disposable income, is at 75%. So 35% of the net income we earn at a household level goes towards servicing debt. What today's decision means is that just by the 0.25% increase, that the average relative cost of borrowing money goes up by some 7%. And what it means is that households are becoming more indebted. We actually had a look at some of the data, Tembekile. 70% of the active credit users that borrow from lenders earn less than 10,000 rands a month. Somebody earning around 10,000 rands a month doesn't mean around 100 rands more towards servicing debt, or that a commensurate increase in your salary to fund that. For many people, it could be pushing them over the line of being able to afford this credit facility that they currently have, Tembekile.
And this is the first rate increase since the pandemic. The Reserve Bank had chosen to keep the rates unchanged for the better part of the year, last year and a half. How effective were those decisions in the past to keep it unchanged? How helpful was it for consumers?
Well, the theory was it was meant to be helpful. If you remember, we were stubborn at a 7% level back in 2018, and over a very short period of time, within March and July, we hit that floor of 3.5%. The intention behind doing that at that point, Tembekile, was to allow people that were constrained. And you remember the stats that in 2020, in the formal sector, some 600,000 jobs were lost, 800,000 in the informal sector, making it 1.4 million. And the data we have says that over 1 million people had reductions in salary. So the purpose of dropping the interest rates gave us the ability to save, to live our life, and to pay down debt that we had already. Unfortunately, the data we have at Transunion, which actually reports on some 27 million active credit consumers, so that many people actually weren't able to save or to use the benefit. In fact, given the pressure we found on the economy, specifically in the early parts of the lockdown, that most households use the facility, the excess money, to fund living and paying for consumables just to get to the consumption phase. The second point worth noting is as the interest rates were quite low, we found as early as May 2020 that most of the key lending products, for example, vehicles, home loans, and credit cards, we saw massive origination happening. What that told us, Thembekile, was that as opposed to deleveraging and saving cash, many people saw it as an opportunity to say, let me take on credit at a much lower rate and actually get access to more credit. So as opposed to deleveraging and consolidating and becoming safer with limited resources, some people may have overextended themselves in the period of this latitude being granted by the Reserve Bank.
You had a report out in September at TransUnion where you said that South African consumers, a third of South African consumers, in fact, plan to either get new credit or refinance existing debt. Have those trends shifted at all?
Well, one of the challenges we found was many people intended refinancing debt, and many of them actually told us they were scared to do so. In fact, in our latest survey, we found that 74% of the people that we asked why they had not refinanced their debt, they actually said they were quite concerned that if they had taken on refinancing and new arrangements, that if they defaulted and they actually couldn't repay that, they were scared that the lenders would call them up and they'd be in further trouble than the current situation they are in. So many people had benefited, as you remember, from the payment holidays offered at the earliest part of the pandemic, and many people took up the payment holidays. But in many cases, as the strain actually went onto the household, some of them actually sat in those situations, were not doing anything about it, even though they may have had the option to talk to their lender and restructure their debt.
And how receptive have lenders themselves been, given that the businesses have also felt the pressure during the pandemic, cutting jobs, moving to smaller premises and the like?
It's been really difficult throughout the pandemic. I think the biggest impact has been on these small, medium businesses. We've seen governments around the world offer up support for SMMEs. In fact, our data at TransUnion tells us that almost 1/3 of the SMMEs in South Africa have shut down during the course of the pandemic. And the sad part here, Thembekile, is that these SMMEs, particularly the medium and the micro enterprises in the township economy, are a large employer of jobs. Given our high unemployment, it is tough in the economy. Consequently, what does it mean for the lenders and the big businesses? It is quite tough because, as you say, they need to run meaningful businesses as well. We actually saw many lenders offer payment holidays at the start of the pandemic, back as early as March and April 2020. But as they started to feel the strain in the economy, many started to adjust the risk criteria that would extend credit. And many people that were struggling in the pandemic actually struggle today, and they for sure will struggle as the interest rates go going up, because if they weren't able to afford credit extended by the lenders during the pandemic at low rates, as the governor pointed out, as we go into the upcycle, they will struggle even more to access credit, whether it is to appease their needs in their household or just to take on debt for a house or a car. It can be a lot more difficult as we go forward.
Please stand by for us. We're going to continue our conversation shortly, and when we return, we'll ask the Transunion CEO Lee Naik about whether there is any such thing as good debt. We'll also talk about when is the best time for you to approach your creditors and tell them that you are backing to pay. Stay with us. We continue our focus on the back of the repo rates announcement by the Monetary Policy Committee of the Reserve Bank. Today we're focusing on you and your money. Consumer debt is our focus tonight. We're speaking to the Transunion CEO Lee Naik, who's joining us from Johannesburg. Lee, let's pick up on the discussions that need to happen between an indebted person and their creditor, whatever business they owe money to, and talk about when we should actually approach a business or creditor to say, listen, I'm battling to pay, and let's perhaps look at a potential arrangement?
That's a really good question. As I mentioned earlier, we have some 27 odd million active credit consumers in South Africa out of an adult population of some 40 million. Now, probably before I talk about what the strategy is, it's probably important to note, Thembekile, that most people are quite scared of their financial health. I mentioned earlier the high level of indebtedness at 75% of our disposable income. You may know that every credit bureau in South Africa, and there are 5, we're one of the 5, are meant to give you a free credit report at least once a year. You'd be surprised to hear that of the 27 million active credit consumers, only some 600,000 people get their free credit report, even though it's freely available once a year. And that talks to the point of the level of indebtedness and people being scared of their financial health. Over to the point of when do you approach your lender? At the first time that you may not make a payment, it's important you reach out to your lender, whether it's to a retailer, a bank, the car payment house, your vehicle finance. You want to reach out and say, I have a concern. You find that most lenders are very, very amenable and open to talking about how they could structure your repayments for you or how you could go about setting up a payment holiday program. When it is too late, after you started to miss 1 or 2 payments, in our industry, we call this a default. And a default on your credit record, Thembekile, can take up to 2 years to go away because the banks and other lenders look for a behavior in how you want to pay back debt. And if you miss 2 or 3, it could take you up to 2 years to improve your credit status. And that could affect your ability to take on credit.
Controversial point, I know, when it comes to debt management, it has to do with whether people should go into debt counseling. Your thoughts?
Well, debt counseling is probably the last intervention you want to consider. And in our industry, we always talk about knowledge being power. And as I said, get your free credit report, tells you the full profile of what you're indebted for, and that can inform what you pay off. And to get into the position of talking to a debt counselor, we always say it's the very last step because it actually cuts you out of the credit cycle for a period of time. And given the level of use of credit, it could impact your ability to live your life and to go about how you live your life. So it is the last step in the process, in our view. You want to start by trying to understand what you've got to pay, try and pay that on time, and if you can't, reach out to the lender. And under the auspices of the National Credit Regulator, you could go to the step of going to a debt counselor and talking about a specific plan to help you get full control back of your financial health.
It also appears, Lee, that it's become easier to get into credit, get credit and get into debt because a lot's now happening online, digitally, as far as people making purchases. What have been your observations about consumer behavior online? Because scams as well are quite rampant where people's details are taken and used for whatever reason.
It's actually a really good question. As a technologist myself, we actually found in the first 6 months of the pandemic that many people migrated to online transactions because we were in lockdown at level 5 and level 4. And actually many businesses were forced to transact with us digitally. Now, many people still transact digitally. In fact, we found that people have stuck with the ways of using these online services that will bring the product to your house completely sanitized without you having to leave the confines of your safety net. As a consequence of going online, actually has promoted a new way of buying. So the same way we have instant gratification using social media, we're now able to have food products delivered to our house and even returned for free in many cases. It also has opened the opportunity, Thembekile, for online fraud targeting to increase. We actually found that many industries, online services were being targeted. In fact, the number 1 area that was targeted was online gambling. Even though we have quite an indebted society, many people use online gambling as a vice. In fact, as many as 1 million people use online casinos every month. We saw an increase of 934% in online gambling being targeted for digital fraud. And almost a third of these people become actual victims and fall victim to identity theft or to credit card theft. So it is innovative in that we're able to access services and transact and consume services. But equally so, it comes with more responsibility on the businesses to protect our data. And as you remember, Thembekile, from 1 July, we now work under the auspices of the POPIA legislation that needs to protect our data. So that pressure infers new responsibility on us as consumers, but also on the businesses that seek to keep our business.
And Black Friday next week, a lot of us are going to be trigger happy, or shall I say, click happy online with all the discounts and all the purchases. Are we at our most irresponsible as South African consumers during that day, that weekend of frenzied buying?
Well, I'm actually pleased to tell you, I'll share with you some data that, your channels and you have first access to compared to other media houses today. But we've had a chance to study Black Friday. In fact, it's Black Friday month, not just a week. In fact, many people have been targeted for sales well before Black Friday, which is 2 Fridays out from today. And what we found is really, really interesting. One of the things that we wanted to study can be key was there a generational pattern in how consumers were actually spending. So many people would accuse youngsters born after 1980, which is your millennials and your Gen Zs, of spending more. We actually found that older populations born before the year 1981 actually spent more during Black Friday on average than millennials and Gen Z. So that's the first data point that's really powerful. The second data point, which is quite scary, was that many people opened up accounts in the month of November for the purposes of maximizing purchases of Black Friday. We found in 2019 a gradual increase in people opening up new accounts. But as we saw the interest rates lower, we actually saw an increase in the utilization of credit to purchase things. So whether it was millennials or older folk, we actually saw a drastic increase in people taking up credit to buy purchases. Now, it can be clear, it wasn't just clothing, it was furniture, it was equipment. For the older folk, it is typically trying to buy larger appliances, which are typically the items that go on sale throughout the Black Friday. In the last set of data, we actually found that millennials were actually not looking at clothing or any kind of clothing product as much as they're looking at actually buying equipment or buying furniture for their house. So something tells us from the data, which would be interesting for this year, that the millennials appear to be a lot more responsible and are aware that a credit decision could impact their young careers as they enter the business world. The other data point we did see was that consumers display what we call a payment hierarchy behavior. And what that tells us is that many people have many products of credit. You may have vehicle finance, you may have a mortgage loan, you may have a credit card. And it's important to note that if you don't pay your credit product, you could go into default, as I mentioned. What we did see was that most consumers, whether you're a millennial or an older consumer, you actually respected your credit card payments the most, and these credit cards were the least in default. What we find typically is around 6 months after Black Friday, almost a third of consumers have gone into default because they can't afford what happened in Black Friday. What the data, the new research we found told us that people respected the credit card the most because it has a concept called open utility, meaning I can use my credit card for groceries, to pay my fuel, to buy clothing, whereas other forms of credit are less restrictive. So it does feel that millennials are driving a way of saying we've got to be somewhat more responsible, but they're also well aware of some of the risks that come with being indebted. Now, I must remind the listeners and the viewers today that we are an indebted population, and for us to take control, there are tips that I can share with you as to how you make better decisions.
Okay.
But Black Friday will in fact give you many options if you do want great deals.
We don't want to make responsible decisions, we just want to splurge. What are those tips, Lee?
Well, the first thing that I do quite often is actually ask myself, what do I want to buy in Black Friday? Many people know well in advance, maybe from last December, what you couldn't buy for Christmas and what you'd like. Make a list of what you'd like and ask yourself, if I could afford one, which is the one thing I'd buy? If I could afford two, what's the two I would buy? That's the first thing. Second thing is get that credit report I spoke about. It's free once a year. It'll tell you what you currently are paying and maybe considering your disposable income, what you could afford. So considering what you could afford to take on as debt, knowing what the government said that there will be an interest rate cycle, decide whether you're going to buy 0, 1, or 2 of the purchases. Also remember that when you do buy these purchases, you're going to have to honor the payment. You may also remember that it's tough in the business environment, and there will be sales throughout the year. We have Christmas coming up. We have the January cycle. If you can't afford it, realize and look in the mirror and say, it's you that have to pay back this debt, not your friends, not your family. With great power and knowledge comes responsibility. So make more judicious choices informed by the data you have. The data, Tembekile, can be really powerful in making those choices. You may find that great TV you wanted to buy, but maybe you can't afford it. Wait a bit longer, save the money if you can, and make that purchase when you can afford it. Credit is powerful if used responsibly.
Okay, quick final one. What are you splurging on next week?
I haven't thought about it yet, but what I was thinking about was probably another television, because everybody wants a bigger television every year, don't they?
Get a bigger television, keep it on channel 405, Newzroom Afrika. Lee, thank you so much for speaking to us tonight.
Thank you, Tembekile.
That was Lee Naik, the CEO of Transunion, the credit bureau, speaking to us tonight about the levels of indebtedness in South Africa. As we head up to the next hour, just to let you know, we're going to be focusing on developments around the rates announcement by the Reserve Bank's Monetary Policy Committee. We're going to look at the cost of food in South Africa and how much pressure this new rates announcement is going to add on many of us who have to feed not just ourselves, but our broader families. And then a discussion about the worsening situation in Sudan, where protests against the military takeover have continued for another day.